Welcome to Stockwatch with me, Ray White. Or joining me to unpack your stock-related questions today are Rowan Williams from Nitrogen Fund Managers and also Jonathan Fisher from PSG Wealth Sandton Grayston. Be sure to send your questions, though, through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using, of course, the hashtag Stockwatch. Gentlemen, hi. Good to chat to both of you. Oh, it's budget week, and here we go ahead with the budget. I think, Jonathan, let me start with you and looking at the budget. I mean, what are your thoughts? I've got so many WhatsApps, so many emails coming through, people asking the question, what should we expect and how will it affect the markets as well? What are you looking at?
So I believe it's going to be a decent budget. I think we're going to see a nice budget surplus. And part of the reason is because we've seen such huge profits coming through from our big gold miners and platinum miners and other general miners as well. But it's been a big windfall for the fiscus. So I think it will be a good budget in that sense. I know, the biggest concern is the deficit. If I'm not mistaken, it's around 78% of GDP at the moment. And government's intention is over time, over the next few years, to reduce that and keep reducing that. So I don't think there's going to be any major tax hikes coming through. There'll be the odd creep here and there. I think the sin taxes will go up as they do every year. But generally, I think we're in for a decent budget. And what that will mean for the market will be positive. Part of it's probably been factored in. We could see further rand strength, on the outcome or on the announcement of the budget. But I'm expecting a good week or a good budget later this week.
Yeah. This time last year, Rowan, we were looking at that VAT hike. You remember that? They were going to add on 0.5 percentage points. And then there was all that kickback and blowback. This time around, as Jonathan said, things seem to be a lot better, a lot stabler. What are you looking at?
Yeah, so I think we have come a long way since a year ago. There were sort of, fractious interactions between the GNU members and sort of fighting over a 0.5% VAT hike. Fortunately, I think the fiscus situation has improved significantly, that we don't need to get to that sort of level of detail. So, as Jonathan said, it looks like we're running a primary surplus that will allow debt consolidation and overall reduction in debt to GDP ratios coming down. That's all positive for bond yields, and you're getting to sort of a virtuous circle where the cost of interest comes down. The Reserve Bank's done a good job of the new inflation target, so that's reducing the cost of debt. So I think we've got significant tailwinds. We're not going to see, fiscal drag like we've seen. So some tax relief there. The consumer, I think, needs to come to the party for the economy. So I think it is going to be somewhat of a stimulatory budget, which I think is really what the economy needs at this point.
Yeah. Right. Jonathan, one thing that may be in the budget speech on Wednesday is US President Donald Trump. 10%, now 15%. I mean, do you think at some point South Africa is going to say, hey, hold on a second now, we need to take some sort of standpoint with US President Donald Trump?
I don't think that's a good idea. we saw what happened last year. President Trump does what he likes to do, and in essence, I think he thinks he's the boss of the world and can bully everyone, as he does with the smaller players like South Africa. So, these increased tariffs based on the Supreme Court Supreme Court ruling on Friday, it's just typical Trump way of doing things. How it's going to affect us? Well, we don't like to have these tariffs. I mean, it's already affecting certain industries' ability to export to the US profitably, and reducing basically goods being sent over and exported to the States. So, I don't know what government can actually do in a meaningful way to stimulate and to kind of push back against the US. We're very lucky that we remained in this whole AGOA trade. How can I say that? The AGOA kept going through, and I don't know if Trump was aware that we're actually still part of it or not, but to the benefit of the whole continent. So, yeah, it's a difficult one for the politicians to play, but, yeah, it'll be interesting to see if anything comes out of that.
Yeah. Rowan, I see you smiling there, and I can only help but think to myself, do we really care? Do the markets even care about US President Donald Trump anymore? Because it's rhetoric after rhetoric. And if you heard those sound bites in response to those US Supreme Court justices, you can only think to yourself, Guy, whatever. Are the markets seeing it the same way?
Yeah, I think the markets have, to some extent, got used to the rhetoric, as you point out, and they discount it often. Sometime last year, various market pundits coined the term taco. Trump always chickens out. And analysis I've seen is that he follows through on one of four of his sort of threats, be it a regulatory threat, a tariff threat. So you do have to listen and understand, but I guess you can also take it with a sort of a large pinch of salt in that. I think there's going to be a lot of talk, a lot of noise, but in the background, things carry on. South Africa's finding new export markets for their products. We're managing this change as a lot of other economies are around the world. So I think we're in a much better and more comfortable place globally and with global trade. And there's going to be a reordering of the system. I think we've all come to accept that. And this is going to be a sort of ongoing process, but reduce volatility from the noise.
Yeah, interesting stuff. Right, Rowan, I'm going to stay with you. Tongaat Hewlett, I've received so many emails about this. It's the sugar industry. Where do we stand with Tongaat Hewlett? Because it's email after email. What are you seeing? It's touch and go here.
Yeah, so I guess it's been a long time coming. I mean, we know the business has been in business rescue and has been struggling. Sugar commodity producers, not entirely competitive, has a significant impact, I guess, particularly regionally and downstream on those small cane growers. So it is very concerning. It speaks to also the continued sort of de-industrialization of South Africa, the failure of these major manufacturing operations. So I think without the government having sort of a clear economic policy, and they have sort of had certain sector policies that done better in the motor industry, for example, economic forces are going to sort of shape them and take their toll on these industries. So it's difficult, because does it deserve to survive, and can it make profits for those investors? So I think to some extent we may have to take the knock and manage the fallout economically and for those communities, which is going to be tough. But we need to find alternatives. But I don't see an easy way out on this one.
Yeah. Jonathan, I mean, this is a major problem. And Rowan, you're right. It's all those KZN communities that rely on that income. It's a whole society there. But what is your take? Because this is where we're going now, and the business rescue practitioners are asking some serious questions.
What they've actually asked, for this company actually to be placed into provisional liquidation. They've tried every angle. There was a crowd that was interested in buying them. I think it was Vision, but that's fallen by the wayside. And it's unfortunate. I think mostly, like Rowan said, for the workers, for the small-scale farmers, depending on the firm, for income and the knock-on effects it has on society in KZN. And then, of course, for shareholders, it's just a loss completely. We've seen companies go into business rescue 99% of the time. They don't come out of it. They go into liquidation, and then equity is lost completely.
Yeah.
So that's probably, unfortunately, what's going to happen. I did read that the DTI is totally against it, for the benefit of for social benefit, which we understand. But it's a difficult one. If an industry that you're in is uncompetitive, at what point do you stop supporting and supporting? We saw it with ArcelorMittal. We're seeing it with them. Making long rolled steel that's just not competitively priced. At what point do you keep supporting where you've got these huge competitors offshore, whether it be China, whether it be Brazil, as far as sugar goes, competing against much smaller operators here at higher cost bases. I mean, that's in a nutshell what it's about. So, and then you get back to the tariff discussion.
Yeah, it's crazy stuff.
Is difficult.
Yeah, crazy stuff. Well, yeah, we'll just keep an eye on that one. Looking at all the emails coming through now, Spar once again making news headlines. We had it last week, of course, with their CEO saying he's stepping down. Now, of course, they've had some results out today as well, and they're not looking great. We've had Pick and Pay; they haven't been looking great. Jonathan, let's keep with you. Looking at Spar, what are you seeing?
Well, I'm not seeing a pretty picture anywhere. It's been a bit of an ugly picture, for lack of a better adjective, over the past few years, for various reasons. We know what they are. It's implementation of SAP systems. It's one of the big franchise owners. I think they own 46 stores, suing their company. They've got numerous problems. And quite frankly, I don't think it's a good investment thesis anywhere right now for Spar or for Spar shareholders. So we saw that operational update come through, not great. Perhaps, coming up at an opportune time, based on what happened on Friday, with the CEO stepping down and the share price dropping 7%. So in my mind, no, don't like Spar. Having said that, I think that sector, the food retail sector, is not in an easy space. The consumer market is tough out there. In my mind, the best player in that market is Shoprite. But still, when you're growing turnover at mid to high single digits, inflation's at 4 or 5%, earnings per share are around about similar levels, you're not going to see huge growth. It's not as exciting as Boulder Platinum shares, that's for sure.
No, nothing's as exciting as that at the moment. Jonathan's right. There are problems there, but where are we going with Spar?
I think what it demonstrates is in a tough trading environment, which we have, it's obviously becomes exponentially difficult to execute a turnaround. And so they've had a few missteps. I guess the SAP implementation at KZN set them back significantly. And they'd promised the market that they'd get margins back up to 3%. Now they've had to move out the timetable for that once again, and putting pressure clearly on the entire executive team, seeing changes there. So it's very much a work in progress. I think, unfortunately, shareholders are going to have to be patient. We do hope that the trading environment can improve, but it looks like it's incredibly competitive, pressure on margins. So this is a sort of a long-term story, and I think the shareholders are going to have to pay very close attention to execution here to ensure that the business gets back on solid footing.
Right, yeah, absolutely. Let's climb into some of the emails. Francois Greef Jr. says, it's a good time to invest in companies such as BAT and Philip Morris, he says. He thinks, but he wants your advice on this. Francois says, I have seen a lot of advertisements from Velo and Zine on Formula One cars. Tobacco companies have invested heavily in smoke-free products, so therefore, is it a good time to invest in BAT and Philip Morris? Francois, I'll start with you.
Yeah, I'll take that.
Go for it.
Yeah, so British Tobacco and Philip Morris, great companies. They're close to all-time highs. They've done pretty well over the last year or so. I do think that their businesses are evolving more to the new age products and that's a concerted strategy that they're busy with. I was looking at British Tobacco last week, and the results actually been pretty good. They're growing around about 5-6% in constant currency terms from a top line perspective, as well as from an earnings per share perspective. And they've got very, very good cash flows. It's both companies actually are cash cows, because they generate so much cash. So whether it's a good time to get in now, I think they're quite defensive. We saw British Tobacco under quite a bit of pressure about a year and a half, 2 years ago. And over the last 12 months, there's been a huge improvement in the share price. So I guess one would be getting them at the top. Philip Morris, kind of similar. They're priced differently. Philip Morris is a much bigger business. I think it's worth about $280 billion, whereas British Tobacco's got about a market cap of half of that. And, they're priced differently as well. Philip Morris is on a 25 times multiple versus British Tobacco, 12 times multiple. But you're getting a nice yield on both of them, around about 5%. So I do like both of them. It's just a matter of trying to pick a price and not pay top price.
Yeah. Interesting, Rowan. Okay, if they are at the top, if they're peaking somewhat, is it time to join the train? All that advertising and all that marketing.
So, Jonathan points out they traded sort of different multiples. So I think on analysis, it does look like British American Tobacco, there's still some room to grow from a share price perspective. I think the market's been a little bit concerned about their transition from cigarettes to smokeless tobacco products, but they're proving to have executed fairly well. That portfolio has actually reached its profit targets and objectives earlier than anticipated. It's becoming a bigger portion of their overall earnings. So I think we can continue to see a re-rating of that stock as they continue to execute and deliver. So I think for me, British American Tobacco looks interesting here. The others maybe I think are sort of fully, the prospects are fully reflected. But BAT, still with punt.
And this is despite them having South African problems with illicit cigarettes.
Yeah, so unfortunately, again, that's Chat's our earlier conversation where we see deindustrialization. I think they're going to continue to trade in South Africa, just not continue to manufacture here. So that's where we're losing out as an economy. I think hopefully, the government will improve, just the implementation of excise duties and clamp down on that smuggling, which I think the SARS is looking at. So. But it's a global tobacco manufacturer, so I think it's a small part of the overall operation.
Yeah, absolutely. You're getting a nod there from Jonathan as well. Right, some of the other ones as well. We spoke earlier on about SPAR, but the other big story today is Sasol. Greg saying Sasol has seen its first half-year profit fall. Should I wait to see the share price drop again and then buy? What should I do with Sasol? It's such a difficult one, Jonathan.
Look, I'm not a fan of Sasol. If one looks at the results, there's like hardly any glimmer of light. I think one or two spaces where you can say there is the destoning project is improving. So and actually their efficiency at Secunda has improved, but ultimately, the EBITDA is down 12%. And the reason for that is because of low oil prices and the lower chemical prices in terms of what they can sell their product for. So, I don't know, headline earnings per share down 34%, no interim dividend. It's a tough business that they're in. Personally, I'm not a fan of theirs. The share price has actually moved up quite nicely over the past couple of weeks, sitting at, I think it's about 140 now. But I'm not keen on Sasol personally.
Yeah, it's not your thing. Rowan, Sasol for you?
Yeah, it's quite a divisive investment case. I think some people like it and feel there's sort of room for it to grow. They maybe remember the glory days of Sasol when it was sort of, I think, close to 500 Rand a share. I think management are doing a reasonable job of controlling what they can control, managing costs, capex, and attempting to make the business more sustainable at a lower oil price. But I think the key investment case it relies on what you believe the oil price will be in the future, and I guess off the back of that chemical prices as well. So, and we concerned sort of in the medium term that notwithstanding sort of short-term fluctuations due to geopolitical concerns, that the oil price will continue to trend down, and that will make things very tough for Sasol. So yeah, I think we're in agreement with Jonathan here. So we don't like it at these levels.
Right, Sasol gets the thumbs down. Let's talk about Nedbank now. And I've got you. Anonymous says, with banks such as Nedbank diversifying and looking at assets in other countries such as Kenya, is this a risk to investors? Now, I think Nedbank's been doing pretty well. Jonathan, your thoughts?
I think Nedbank's probably due for recovery, and in fact, it has started recovering, certainly on the share price. We've seen a nice pickup since October last year. And I think under the new leadership of Jason Quinn and other leadership changes that have happened on the board, they're probably, going to continue on the recovery phase. I think, the acquisition of the remainder of 66% of this NCBA subsidiary in Kenya is a good acquisition, and it kind of, it emphasizes the fact that there are opportunities on the continent where countries like Kenya are growing at a much faster rate than South Africa. I mean, our GDP, we're hoping this year will come in at 1.5%, whereas Kenya's GDP, I think, is about 5 or 6%. So I think this is a good thing for them, and it has been the laggard in that sector of the big bankers. Them and ABSA. ABSA's also showed a nice turnaround recently. So I think Nedbank could be a good one. I think the interim results will be out soon.
Well, there we go.
Sometime next week.
Anonymous, I hope that helps. What do you think, Rowan? I mean, it's interesting to see what companies are doing today. We've seen that in telecoms as well. People are looking outside of the country, in Nedbank in Kenya. What are your thoughts?
Yeah, so I mean, we have seen Standard Bank and to a certain extent ABSA have fairly strong African franchises and operations. And the view is right, there are increased risks, but with those increased risks come with increased returns. So you're seeing a much higher ROEs in those markets and those African operations. So it helps just in terms of the overall balance of the portfolio, and as Jonathan pointed out, much higher growth rates. So I think it is quite attractive with South African banking skills in a growing market like Kenya or other African markets that the banks can do well. So I think it will be a good investment for Nedbank. They needed to increase their presence in Africa after selling EcoBank. And so it's certainly a step in the right direction.
Yeah. Right, gentlemen, time for your stock picks. Jonathan, let's start with you. What are you looking at the moment as your stock pick?
Yes, I'm going to go with one of our big companies that's called Remgro. Everyone talks about South African companies, South African Inc. companies. Well, here's a great holding company that's got some really good assets, holding pretty well. And it's involved in different industries, from health in terms of Mediclinic, consumer goods, you're getting Sasol, RCL Foods, Rainbow, Heineken, financial services, you're getting a big chunk of insurance, as well as some shareholding in Discovery and a little bit of FirstRand. And then interestingly, and also a big opportunity is the infrastructure play, that's telecoms, where they own Dark Fiber Africa and Vumatel and Seacom. And then there's also the industrial business, Air Products SA, Total Energies. So it's a great business. They came out with really good full year numbers for June, where earnings are up 38%. The interims are for December due next month. I mean, if they can grow, or if they have grown at a similar rate, which I suspect that they have, then it's probably still cheaply priced. It's like I mentioned, 100 billion market cap. trading on a multiple of around about 12.7 or 13. If they can produce the same kind of growth in this economy with their investments or investment companies as they have in the last financial year, then a PE could drop to 11 and 10 times based on earnings growth of 38%. I don't know if that's doable, but I think it could be.
Yeah, something to watch anyway. Rowan, your stock pick?
Yeah, so we're also going with another large investment holding company listed on the JSE, in this case, Process. So you could choose Naspers or Process, I guess. What we have seen is some of these global tech stocks sell off quite significantly this year, just around concerns about valuation and also the impact that AI is going to have on their business models in the medium term. But I think what you are going to see is winners and losers, and we believe Process, through their various investments, mainly Tencent and the food delivery and the e-commerce assets, is going to be on the winning side. And I think it's been unfairly sort of priced down when Tencent's executing incredibly well, still a global leader in gaming, and the new leadership team at Process doing an incredible job of extracting value from that portfolio. So we see in the medium term that discount either being reduced significantly or ultimately eliminated, and you're getting strong underlying growth in the operation. So, and a nice entry point at this point.
Both great stock picks, Remgro and Process. Gentlemen, thank you so much for joining us on Stockwatch this evening. Really do appreciate you taking the time. Thank you so much. That's all for Stockwatch today. Thanks to our guests, Rowan Williams, also from Nitrogen Fund Managers, and along with Jonathan Fisher from PSG Wealth Sandton Grayston. Up next, the close.